Now to our first discussion this afternoon. The Central Bank of Nigeria's Governor, Mr. Olayemi Cardoso, has announced that only verified claims in the outstanding $7 billion foreign exchange backlog will be paid. The Apex Bank boss noted that despite how long it has taken, the clearance of the backlog would help multinational businesses and investors repatriate their funds. He explained that decisive steps had been taken to address the foreign exchange liquidity constraints and emphasized that this initiative had restored confidence among market participants. Mr. Cardoso noted that several unverified claims discovered by the forensic auditors during the verification were also being reviewed and were nearing the final stages of classification. He reaffirmed the government's determination to strengthen the market and rebuild the trust that investors rightfully expect and deserve. Well, let's bring in Professor Ken Ife, a global economic consultant, entrepreneur, and key speaker whom for over 30 years has spoken in over 40 countries, delivered strategic programs within engineering, technical services, enterprise development, and public policy. Prof, good afternoon. It's good to see you.
Thank you very much for having me.
Prof, I think it's good to start with the recent efforts of the Apex Bank. I think it started from December when the Firms initiative started, and the CBN has been following up with series of initiatives to back up the currency. Not what we used to do before, but something different from what we used to do before. And of course, maybe that's why we're getting different results. How does this come to you? What is your understanding of all of these new initiatives of the Apex Bank aimed at stabilizing the Naira against the greenback?
Well, you can see without an iota of doubt that the central bank is actually really driving the Forex arena right now. It's got a handle on this. But remember how it all started in 2023 when the new president was sworn in. There were two major actions that he took. One was to banish the fuel subsidy. The other one is to go for unification of the various exchange rates. And to that extent, although it took some time before the new administration came in, that is the new central bank governor came in, but when he came in, he tackled it head on. Many measures were employed, of course, many tools. He looked at the bank, he gave them that 20% room. They were bringing sanity into the system. You were having convergence of the various rates. You now had some other tools that were brought in by Monetary Policy Committee to hike interest rates, and then that encouraged Forex inflow, from that is portfolio investment inflow. But there is still this unresolved issue about in the banking sector, we have what they call prudential guidelines. And that has maintained the financial system stability over the years. And nobody even talks about that. They only talk about, price stability. So the same thing is coming in the arena of Forex management, where they are now going to introduce new Forex code, which is like an inspection framework, management framework, risk management, transparency. It guarantees so many things that would enable you have good framework for managing the whole of that sector. And it's quite varied. It's not just the banks. You have BDCs, you have other players that are licensed. And they are licensed not only in relation to the CBN Act, but also to the other act, the Buffy Act 2020. So those who are licensed under both acts come under this regulation. And it's important to note that they just went for international standards and regulatory practices with around 6 pillars. One pillar is on ethics, that is ensuring that there is, professionalism and best practices being in ethics. So that's one. Of course, governance is very important there because they wanted to make sure that the operations of those Forex has an implicit supervision and oversight by the board. So there's a board commitment. So, and then you have the other one of execution, how the implementation modalities, and then of course information sharing. If the information brings in transparency in the management of information and the provision of information, and then also protecting the integrity of the privacy of the people who are doing these transactions. So you have to guarantee their privacy. Then they also brought in things like risk management, which means carry out risk assessment and then allocate the risks and then manage the risks. Then you now have compliance issue, which is about inspection, regular compliance. So what the bank did is to say to them, look, let's go for self-assessment. Assess yourself. So it gave them the templates to carry out their own self-assessment and then make sure that the board is in the picture and provide the evidence that the board is in the picture so that the board is being pulled into oversight function. And then, every quarter, the bank will now come to review and inspect based on what has been submitted to them. So that is a very, very important way. And then the bank will now be at liberty to use, either risk-based supervision, it would use that, but also audit-based controls. In other words, how does the bank penalize infractions? It has to decide how it penalizes it. Maybe have a fixed way of penalizing, or may say, okay, if it is 10%, when we'll sample your thing and then we'll find 10% error, then we inflict 10% across all your transactions. We don't know that yet. But the bank is going to be, right on track, monitoring them. But this is the latest. Just before that, there was the one that they implemented, which was called electronic foreign exchange matching. Yes, and that electronic foreign exchange matching actually moved the rates and started trending down, showing that there's an impact. As soon as that happened, you saw the rates move in 27 December from 1,550, it moved to 30th December, it went down to 1,527. And then as the new ones came, even yesterday, it went down to 1,527. And even today, it went down to 1,505. So what it's saying to you is that people are now beginning to have confidence, because lack of transparency makes people lose confidence in the system. Now there is confidence in the system. It's going to be managed the way they'll be using prudential guidelines to manage the operations of the banks on a monthly inspection. And that's actually joint inspection with NDIC. So that is bringing sanity. Now, when you have this, when you enforce this regulatory standard, people will now begin to bring their transactions through you. Otherwise, they will continue to use all other means other than you. So that is the impact of that. But also, this is also necessary because the bank has spent over a year now looking at the $7 billion backlog. Although it had to quickly settle the airlines because the airlines were becoming so notorious. They had to quickly settle the airlines. But there were huge $7 billion backlogs that they continue to carry out forensic examination on. They had the services of Deloitte management to help them on that. And they seem to be coming close to the conclusion of those. And I can even tell you that about $2.4 billion of those are frivolous claims, which they don't think are going to be valid or going to pass through. So that's the early results that they are seeing. So what do we have? We have a regime of unethical practices. We have a regime of illegal transactions. And some of them pose so much problem. Some of them are criminal in nature. But then the bank needed to sort that out and then provide a new framework going forward on how to have a serious regulatory stance.
Prof, it's good to start this conversation with this in-depth analysis into what has played out in recent times. But two things moving forward here that would shape, of course, decisions of the Apex Bank moving forward. One is inflation, and it's also this volatility and, of course, this exchange rate issues that we are talking about. Now, with this sign of a bit of stability, looking forward as we move on, we expect a meeting sometime in February. Do you think that the Apex Bank might now start to change its operating model that's talking about interest rates. You know that has been one issue that everyone has talked about, particularly its impact on the rail sector. Do you think that this move, this level of stability we start to see, would shaping decisions moving forward?
Well, what we have to see, you take it one at a time. First of all, the purpose of this, of having an effective management oversight and risk-based approach, is to actually maintain integrity and transparency, and then ultimately enhance forex liquidity. So transparency, enhancing forex liquidity, and guiding the market players. There are a lot of people there in that marketplace, guiding them in a very sensible and appropriate and to see how efficient that market can be. That market, if it's very efficient, can actually encourage more inflow of dollars. And then that means that could attenuate inflation, because after all, when you have more influx of dollar, it tends to push down the rates. And the bring down the rates means that what we are importing into the country would be a bit cheaper than, less expensive as they were. And you know that whatever you bring in, inflation, foreign inflow of inflation, not straightly away, goes straight to the consumer. So, we know that. So that is one way in which it could attenuate inflation. And then, of course, the bank has to cautiously watch how quickly we can move on this. Don't forget that we have stagflation in this country, which is the most complicated form of inflation. So no one parameter can deliver a sustainable drop in inflation rates. Obviously, the MPR and other tools are doing their bit by freezing out the current excess liquidity of Naira in the system, and you can see them vanishing with speed. You can also see the banks recapitalizing, sucking away some of those money. Every 1 Naira you give to a bank now to save for you, 50 kobo of it goes to central bank into the cash reserve ratio, instead of 30% before, so that goes away. And then the bank also had its obligated to keep 20 Naira of that, or 20% of that 20% of it as a liquidity ratio. So the bank only has about 30% of that, your 10 pounds or 10 Naira to lend. So whatever the banks have to lend is getting smaller and smaller. And that also makes their own lending more expensive, because what happens is that the spread between the deposit rate they give to depositors and the interest rate they charge to people who are borrowing from them is called the spread. That spread continues to widen as you continue to meet the cash available to the banks to lend. So that's what you see. But of course, you have furious sales of government securities, like you have bonds and you have treasury bills. You have all kinds of open market operations. They're all selling and then mopping up cash from the system. So to some extent now, people are beginning to feel that crunch, that, there isn't much cash around anymore to play around. That will have impact on inflation. But I think in relation to the last thing we had that showed slowing down on the food inflation, I think much of it not only came from monetary policy, but also came from fiscal, like Dangote that gave a Christmas hamper to every Nigerian to say, okay, we're going to subsidize, the equalization fund to make petrol sold at the same price all over the country. Means that somebody had to pick up that bill of the transportation and all that to guarantee those prices. So for him to have that 970 Naira all over the country cost this man well over $10 billion. Over 10 billion Naira. So that means that the marginal cost you would have had added to food moving around the country and transporting of people during the Christmas, all of that were removed. So you could see that the month-to-month inflation, especially in the food price, didn't underperformed. So it went down. So I think we ought to thank Dangote for that, to be honest with you. But those are the things. And we will hope, a bit early, we will hope that this will temper inflation to some extent. But whether it's going to make the Monetary Policy Committee slow things down or reduce the hike is another story. But for sure, I don't think that they would want to drop the monetary policy rate. It's too early for them to drop the monetary policy rate. They might stay, or they might have a smaller increase. So it's more likely that it could be a small increase, but or stay. Don't forget that you're still driving foreign portfolio investment with those hikes, because the hikes, the part of the cost of the hike is the differential between the monetary policy rate and the inflation. Inflation is what all this 30 something, and then the monetary policy. So as long as you continue to have that gap, you have a negative real interest rate. So the tendency is to continue to hike until inflation coming down and hiking coming, you will see some kind of equilibrium. Then they will be tempted to start bringing things down. So it's a bit early to expect them to start bringing it down. That's my view.
Okay, finally, on this part of the show today, before I let you go, Prof, President Donald Trump has come up with a series of policies, and one of it is to drill, and we know what that might mean for the crude oil market. Of course, that's also something that has to do with the FX, because, of course, oil is sold in dollars. So do you see any of the impact of these new policies? Do you see it impacting the market negatively that might also affect the foreign exchange space?
Well, drill, baby, drill means America is, and he did it in his first term. He brought the prices down by increasing supply.
Yeah, he did.
Now there will be more drilling on more sites, so there will be more crude hitting the marketplace. It doesn't even need Saudi Arabia and all that to intervene, OPEC. That alone will bring down the price of crude, without a doubt. And you will see within the next few weeks, the price of crude dropping to around 79, 78, 75. It will be coming down. And it will go down below the benchmark, the projected benchmark rate of $75, which is why I keep saying that it has to come down. That benchmark has to really come down, at least by 5 points. Now, how much will that affect Nigeria? Well, that will lower our revenue, our expected revenue in dollars, but we are already ramping up by 1 billion. We are already committed to 1 million barrel a day extra. So, and we have a very, very, very good output last year. I think about last month, it was about 1.5. So we are ramping up. So what we will lose by price, we could gain by volume. As long as they do something about this benchmark rate, because the benchmark rate will just wipe away what could have been an accretion to our excess crude account and consequently to the foreign reserves. And also, I still fail to say that some of these measures are actually increasing the reserves. You can see the reserves going to over 40 billion, now 40.68 billion. And it's good news. So it's likely to continue to increase. And also, you've got the governor also mentioning that more is expected on foreign remittances. You've seen that, the figure of 31.8 trillion naira in diaspora remittances. So all of those will be telling a story that we are finally beginning to wrestle down the problem with the multiple exchange rates, the fluidity in the system, the corruption reading, and all the lack of transparency and prudence and all of that. So we are coming to terms with those, and more confidence will bring more investments and more money, bring it through the proper channels for you to see. So that's what we are going to see going forward. Is that going to affect Nigeria in other ways? We'll still have imports rising. The adult appetite is rising to import more. So you still see growth in imports, which means more and more pressure on dollar. So if we ramp up production, then that will help. But unfortunately, we don't seem to be ramping up production because credit to the private sector, particularly the manufacturers, is facing a major challenge. So we just have to see how this whole thing plays out. But in terms of Donald Trump, he's going to see the other side of America, because he has a world view of that is antiquated, that is actually an abstraction from reality. He hasn't understood that American public don't buy made in American goods. The people that buy them are Canada, Mexico, and Brazil, and Europe. And those are the ones he's inflicting tariff. And whatever tariff he inflicts comes back to haunt Americans. Americans are the ones who are going to pay those with higher interest rates. So he's going to see inflation in America come up. And then, of course, inflation will come up because he's going to lower all the taxes for private sector, which is good. But then he has to borrow money to balance the budget. It is the biggest borrower in the world in over $20 trillion. And you borrow more, you have to service the debt. And of course, you can go and print more dollars, but both servicing of the debt and printing more dollars will still mean inflation. So we're not going to escape inflation. Inflation is going to hurt. But the prices of petrol at the station will go down in America without a doubt. But the 1.2 million cheap labor being kicked out, yes, the ones remaining will increase their wage. All of them will be going for higher wages, which means that even the products you produce are going to be even more expensive. So costs are going to rise, inflation is going to come, and it's not going to be easy, because what you had, you were able to manage China and American trade war. Now it's America global trade war. And I want to say one more thing on this.
Okay.
When he was there, it was 500 billion deficit between America and China. Now the deficit has even worsened to over 1.2 trillion deficit. So we haven't actually achieved much.
I must thank you so much, Professor Kenny Faye. Always nice talking to you, development economist. Thank you for your time. Enjoy your weekend.
And thank you very much. It's always nice to talk to you.
All right, so much. Thank you so much, Prof.